We have a special video for you today as you get to hear directly from CFI Chief Strategist Bryan Jordan. Today, Bryan is covering what history has taught us about trends in home prices, and he looks at it in the context of today's affordability. The following is a clip from our most recent Tuesday call, and if you'd like to see the entire video or if you'd like to watch future videos, make sure to head to our website and subscribe as a platinum or elite member. And the website address is cycleframework.com. I'll make sure to drop a link to our site in the description box for easy access as well. We would absolutely love for you to join the CFI family. And if you like what you see here, don't forget to hit that like button. So without further ado, here's Bryan.
Indicator that came out last week. We haven't talked about much on this call, but it's interesting and I think illustrative of a broader idea in terms of the influence that valuation has on markets, and that is the Housing Affordability Index. We had the fourth quarter numbers out this week. We actually saw a bit of an improvement in the fourth quarter. The overall housing affordability number for Q4 comes in at 95.8. For first-time home buyers, 63.5. Those are better numbers than we saw in Q3, but they're still close to record lows. They've been putting these out. The National Association of Realtors has been putting these numbers out since the mid-1980s. And we are very close to all-time lows here, the all-time lows having been hit earlier in 2023. Both of these numbers, both the overall number and the first-time homebuyer number, are below 100. The first-time number well below 100 at 63.5, and that means that the median household has less than the income required to qualify for a mortgage on a median-priced home. For first-time home buyers at 63.5, that obviously means that they have, on average, or on a median basis, less than 2/3 the income required to qualify for a mortgage on a median-priced home. What does this mean? Well, let's take a look at the next chart, and we can see the correlations historically between housing affordability and home prices. You can see that the relationship is positive all the way through from a lag of 1 year out to 10 years, but it's a very modest correlation 1 year, 2 years out. Becomes a strong correlation when we get to 9, 10 years out. And we see a catch up in the first time home buyer metric and that relationship with home prices. This is very, very normal. When we compare valuation to price, we see a very soft relationship in the early years of the lags, and a stronger relationship for further out. If we look, for example, at the relationship between price earnings ratio and stock prices, or price to book ratios and stock prices, or price to revenues ratios and stock prices, we see very soft negative correlations 1 year out, 2 years out, 3 years out. But when we get to 5, 6, 7, 8, 9, 10 years out, that's when we see the very strong correlations, very strong relationships. And obviously what happens here is that when the market turns, that turn comes in a very big way when you have an expensive market. The same thing is true to the downside. When you have a cheap market and the market turns up, the turn comes in a big way. But it takes a cyclical trigger to move these structural trends in line with what you might expect. If we take a look at the next chart, we can see this in another way. Here we're looking at historical average 10-year annualized changes in home prices by the starting level of the Housing Affordability Index. And remember, right now, the index, the composite index, is 95.8. So the numbers we had in 2023 were literally off the chart from where we had been historically from the mid-1980s up until last year. But you can see when we had relatively low levels before, for example, in the late 1980s and in the mid 2000s, that gave way to very soft long-term home price growth. Again, 10-year home price growth, less than 1% annualized on average. When we had a relatively inexpensive housing market, the housing affordability index over 150 historically, on average, that meant 6% plus gains on an average annualized basis over the subsequent 10 years. So again, relatively little relationship short term. Just because housing affordability is low now doesn't mean we're going to see weakness in home prices now, doesn't mean we're going to see weakness in home sales now. And based on the weekly mortgage purchase applications numbers, we still have a lot of housing demand. We're off to a pretty strong start here in 2024. But it does likely mean that average changes over the next 10 years are going to be relatively muted, just like relatively high valuations in the equity market likely mean that performance over the next 10, 15, 20 years is going to be relatively muted, just like in the late 1990s. We had high valuations in 1995, 1996, 1997, 1998. Didn't mean we had weakness in the subsequent year, the subsequent 2 years, or the subsequent 3 years, but it did mean relatively soft performance over the subsequent 15 to 20 years. That very likely is what we're set up here for housing as well. So I will leave it at that for this week. Thank you all for joining us, and we'll look forward to talking to you next week.